Have you ever thought of investing in equity to grow your capital but hesitated due to the fear of losing money? Well, then market-linked debentures might be a perfect fit for you. But what are market-linked debentures? Market-linked debentures are a hybrid investment option issued in the form of a bond where the returns are dependent on the performance of the market. If the market goes up, the returns increase, but if the market goes down, the returns decrease. There are two types of MLDs, principal protected and non-principal protected. Principal protected MLDs ensure that the investment principal is 100% protected regardless of the market fluctuations. So, even if the market goes down, you will always get your entire principal at the end of the maturity period. Whereas, non-principal protected MLDs do not offer this protection and therefore are riskier. Let us now take an example of a simple MLD and understand how returns are generated in different scenarios. Here, the maturity period is 2 years, the underlying asset is Nifty 50 index, principal protection offered is 100% at maturity. The payoff is linked to Nifty 50 index returns with a floor that is minimum 14% returns and cap that is maximum 30% returns. In scenario 1, imagine if Nifty goes up by 20%. MLDs will also give you 20% returns as it's higher than the minimum return of 14%. Now let's consider scenario 2 when Nifty goes down by 20%. Despite the market's drop, you still receive returns of 14% at maturity. The principal protection ensures that you remain shielded from losses regardless of market turbulence. In the third scenario, when Nifty goes up by 35%, the MLD's returns get capped at 30%. It's evident from the second scenario how MLDs reduce risk by keeping the principal protected. MLDs have the potential to improve the overall risk-return profile of your portfolio. But how are MLDs able to generate these returns? Let me explain. Let's assume you invest 100 rupees in a 100% protected MLD with a tenor of 2 years where the minimum return is 14% and the maximum return is 30%. 95 rupees will be invested in the debt of the issuer, which is the debt component, and 5 rupees will be invested in the call options in the stock market, which is the market-linked component. The 95 rupees will grow to 114 rupees, assuming that the debt component grows at a 10% annualized interest rate. This interest rate is the cost at which the issuer borrows in the market, and the 5 rupees based on the market movement can either become 0 or increase to 16 rupees within 2 years. Adding the values of both the components at the end of 2 years, the overall value would be within the range of 114 to 130 rupees, resulting in potential returns ranging from 14% to 30% over 2 years. The allocation of debt and market-linked components change across MLDs based on their parameters. And yes, like any other investment, MLDs come with some risk too. Market risk. The returns on the MLD depend on the returns of the benchmark to which they are linked. If the returns on the benchmark are low, then the returns on the MLD can also be low and vice versa. The risk can be mitigated by investing in MLDs that are principal protected, which means that there will be a zero loss to the principal even if the underlying market benchmark gives negative returns. Credit risk. This refers to the risk that the issuer may not be able to repay the principal and the returns. This is the same risk that is present while investing in a regular corporate bond. This can be mitigated by investing in MLDs that are secured and have an investment-grade credit rating. Liquidity risk. MLDs may not have an active secondary market, making it challenging for investors to sell their holdings before maturity. It is always advisable to invest in MLDs with a view of holding them till maturity. Alternatively, you can consider investing in platforms that have the option of anytime liquidity, which can reduce the overall liquidity risk. It's crucial to understand the terms and conditions of each MLD before investing. What about the taxes? Any gains arising due to the sale, maturity or redemption will be treated as short-term capital gains irrespective of the holding period and the listing status, and hence will be taxed as per the investor's marginal tax rate. This taxation places MLDs on an equal footing with other debt instruments like corporate bonds, debt mutual funds and fixed deposits. Let's see how MLDs compare with other asset classes in terms of risk and returns. Fixed deposits guarantee lesser risk but also don't give inflation-proof returns. Whereas equity has the potential to earn higher returns but with higher risk and volatility. MLDs give the best of both worlds by balancing the risk and the returns in just the right way. MLDs are popular globally, but in India, thus far they have only been accessible to large institutions and ultra-high net worth individuals due to their high ticket sizes. At InCred Money, we make MLDs accessible to everyone. MLDs on our platform are secured, listed, and have an investment-grade credit rating. And the best part? You can start investing with just Rs 1 lakh. What also sets our offering apart is the anytime liquidity feature, which is a rare offering in the MLD market. MLDs can be a game changer for your investment strategy. Visit our website incredmoney.com for more information. What are your thoughts on MLDs? Let us know in the comments below and subscribe our channel for more such financial insights. Thank you for watching. Until next time, happy investing.
Investments in debt securities are subject to risks. Read all the offer-related documents carefully.